All right, going live here with potential forecast for 2023. Just some ideas that I want to kind of get out there, things to potentially be looking for. First up on our screen, we have the S&P 500 index, kind of the granddaddy of the markets. And on the bottom here, we have the U.S. 10-year yield versus the U.S. 2-year government bond yields. This is what we call the yield curve inversion. And anytime we make it below the inversion line, people look for a recession. It's probably 90% accurate in calling a recession. So it's something that a lot of people do track, and we've been hearing a lot about it this year. So gets the markets pretty bearish. I wanted to bring to your attention when the yield curve inverts and goes below that line, what happens with the S&P 500 index. So on the green lines that I marked here is when it inverts. And the red line is where it reverts and comes back above the line. And we'll notice that as the yield curve inverts, the market still goes up. S&P 500 goes up, all other general stocks tend to go up as well. Where we have the crashes or the down moves in the S&P 500 index is when the yield curve reverts. It comes back up above that line. We have a short move down. And we can see the same thing happened in the year 2000. We had an inversion, then we had the reversion and sharp move down. We had the same thing in 08, 07, actually 06. In 06, we had an inversion of the yield curve. And then in 07, we started a downtrend in the S&P 500. We had the same thing in 2019, right before the COVID crash. This one went September of 2019. We had the yield curve inversion very briefly. And then 6 months later, a nice drop just as the yield curve reverted. We're looking at the deepest inversion that we've had in forever, for as long as this chart goes, which is, I do believe, 1988. There is another chart that goes to 1965, but this one will suffice for now. But we still have not reverted back up. But I am expecting an up move in the market coming soon in all general markets until the reversion comes up, above the line, probably to 1.5%, something like that. Then I'd be on the lookout for potential down move. And since it's so far inverted, it seems like it's going to rubber band back and really give us a real hard down move. Might be one of the biggest ones we've seen in a while. So that do it for that chart. Let me turn this into one chart, the singular chart. We'll go to this S&P 500. This is a chart of the complete history of the S&P 500 and just marking out patterns and matching legs that we can kind of see that they kind of measure right. They match. In an Elliott wave, we would enumerate these as like a 5-wave structure. We can do that with the notations here with a wave 1, 2. All of this would be 3. This looks like a wave 4, and we're working on 5 here. Once this move is complete, we would expect to retrace back to the level of wave 4, which I'm proposing that it will match the 1929 kind of stock market crash to come down. I mean, this is quite a drop if it comes. To think the S&P 500 could go from 5,000 down to roughly $600 just to make it back down to the previous wave 4. If we zoom in on this last potential wave 5 count, right up near the highs back in 2017 all the way to 2020, we have this expanding triangle. Very rare to see that in the markets, but generally we see that as a wave 4 or the move before the final move up. I don't know that this move is totally complete because I do have a 618 target at 5459 to meet the 618 of wave 1 plus 3. So we might have one more pop up. It's kind of what it looks like to me based on the yield curve inversion. And something that other people might not be talking about, I haven't actually heard anybody talk about it, is a potential bull flag. Now, I do see this as distribution, but what would get maximum liquidity from the market and making a bull flag and popping up? This would get everybody really bullish because they'd be measuring this as the pole and expecting the same move, and then it tops out like right at the top of the channel and then down. That's kind of the way I look at it. I'm probably going to see um, some divergence up there on like a weekly or monthly time frame. But once you see it pop up there and come back down and fall back into this range, it's likely going to fall down to previous ranges, and we might have a really, really bad time ahead of us. Dow Jones looks like the same thing to me. I'm kind of seeing the same pattern, same expanding triangle, kind of a wait for consolidation, pop out the high. If this comes back down any further, I'd say the top is in and we're going down. I do expect it to just one more liquidity grab, though. Yet to be seen. Yet to be seen. Brings us to the gold chart. This is a gold chart I've been tracking for probably almost 2 years now. Kind of what I've been looking at as back in 2016 having an accumulation range, and now we're in a distribution range. So just matching the structures. These look the same to me, and I'm expecting this blue leg to pop up and grab liquidity from above here to finish off the distribution, up thrust after distribution. And if you do see it pop up there and close back inside of this consolidation, like within the same month, the top is likely in, and I'd be looking for this leg to repeat as a 5-3-5 of some sort. And that kind of goes with the potential liquidity that the market might need if the S&P 500 is going down or stocks in general are going down. It might be something that the market's gonna need to sell off everything to get liquidity. Silver is a conundrum because I do see a nice accumulation down here, but I have to think of it as a three-wave move up, A, B, C, and then we will repeat this. Imagine getting silver down at the lows of potentially beyond $12, probably around $8 for silver in like 3 years' time. This is like 2026, 2027 being down at that range, if the pattern plays out that way. If we do see the liquidity get taken above, and then it stays above this consolidation and keeps going up, then there's a problem with the currency, most likely. And the same thing for gold. If we go back to the gold chart, I'm just looking at this as a potential distribution. If it grabs the liquidity above and then keeps pushing up, then it's probably gonna go up to 5,000 or something like that, and we have a problem with the currency, which would be the DXY, the U.S. dollar index. We've been tracking this channel. It pulled down to the midline of the channel, has not closed back inside this box, but if it does, I'm targeting the bottom of the channel at least, potentially bounce and maybe even break the lows here, but it might just bounce off the channel and continue marking up. If the S&P 500 goes down, gold goes down, the only thing that's going to go up is the US dollar. So this could be gearing up for a really big move higher if that does happen sometime around summertime or something like that. But we're looking at a pullback here, back to the base of the channel, and then it continues its markup phase. Something recently that happened over the past 2-3 months as the dollar's pulling back is the euro. The euro looks to be doing a swing failure pattern. So it's going to come back up and close inside the box, especially if it does that at the end of the year. I would see that as pretty valid. I would put my stop loss at the low, and I'd target the top of the box. And that's just general Wyckoff accumulation structures. And I'd expect the top of the box, maybe further, but top of the box, and then maybe it falls back down. Great British Pound is doing the same. structure, coming and grabbing the lows, grabbing liquidity, and popping back up and coming back inside the consolidation. There is liquidity above here, so I would expect that to be targeted. This is a very large time frame to be looking for liquidity, but market's a market. It's going to do what it does. As we can see, this low, this panic low, took out the previous low. So there's no more liquidity to take down here. So markets need liquidity. I'm expecting up there, which is why I want to pull back in the dollar. Do we have the... this is the United States Case-Shiller Home Price Index, and a pattern that I'm kind of going to be tracking over the next little while based on the 18.6-year real estate cycle. We can see that it bottomed in March of 2012. March of 2012. The S&P 500 actually bottomed in 2009, so 3 years earlier than this. So this is a lagging chart to the S&P 500. So I would expect the S&P 500 to top before this Case-Shiller index tops, though they did top at around about the same time last time. Actually, the Case-Shiller topped sooner. It topped in September 2006, and I do believe the stock market topped in 2007 before having that great financial crisis. But the 18.6-year cycle suggests that we'll stay at elevated levels for home prices before having a pullback down. So what that would kind of suggest to me is markets are going to fall before this chart would fall. So home prices stay elevated. We start to enter recession based on the yield curve inversion. Sometime at the end of 2023 or middle of 2023, we start to enter recession. We'll have markets going down, and that dries up the liquidity for people to want to, generally spend in the economy, and they're not going to be buying houses anymore, which is going to put pressure on this probably a year afterwards, and home prices are eventually going to come down because there's just not going to be any buyers. Right now, there's no supply, so these prices can stay elevated for a while, and they should stay elevated till the end of 2025, if not into 2026. So that kind of paints a picture for home prices coming down into, probably 2029, 2030. Very, very large macro ideas, but just matching the pattern. That's kind of what I see before home prices rise. What comes after? If we do get the move down that I'm suggesting, starting sometime next year, I'm expecting a V-shaped recovery, or at least it'll look like it on a monthly chart, that the S&P 500 comes back to previous wave 4 of the lesser degree and then bounces back up, all within about 3 years' time. The economy, or the general economy, probably won't recover for 5 or 6 years, but the markets will go up, because this is where I expect the universal basic income to kick in, just based upon despair in the communities. People not having enough money to spend, general economy malaise, what have you. Central bank digital currency, perhaps. That's kind of an idea that I'm having. And that would devalue the currency as people get universal basic income. And then we truck sideways on the S&P 500. I don't know if anybody realized this, but it's been a while since we've had a nice consolidation for like 10 or 20 years. We haven't had one of those in a while. I think we're going to have one coming soon. It's something to watch out for. Thank you all very much for listening. Please give me your feedback on anything to add into the video, or things you might not understand, questions, comments, death threats. Have a nice day.